Thanks, John. Well, thanks very much for having me here. I have to admit that as I walked in, I was out in Winnipeg for a few days, and as I came in, I got a few tips and saw a few friends that I haven't seen in a number of years. So what I did is I took the brochure on Advocis, the Advocis meeting today, and I actually rewrote my speech right here. So that's what you're going to get, because I made sure I got a little bit better flavor for what's going to go on in here today. So I've also said tip me off at the 8-minute mark, because I'm going to keep this right on time. My portion of this is to really talk about the history of what's happened in our industry over the last number of years. Some of you remember it very well, others are a little younger. And then move right to the regulatory issues that affect both the life insurance representative, which is the business I came from, and the mutual fund representative in terms of the regulatory world. Now, there's really been three phases that we always talk about in terms of a development of a product or business. And I'm going to quickly run through that and get into the history. There would be, when you're starting out in the mutual fund industry at one time, was very, very new to all of us a number of years ago. And that started out in the distribution phase, which was essentially high payments to distribution. The commissions were very high because manufacturing wanted to get out there and sell their product. Soon after that, you went to what we call the adaption phase, and that's when manufacturing has now made its mark on the industry, and it lowers the commissions, changes the format, and actually starts to sell directly to the public itself, still using an independent distribution force. And then the third phase, and the mature phase, is what we call the consumer phase. And that's what we've been going through the last number of years. We have a mature business, and the consumer phase means more regulation and lower fees on the manufacturing side and on the distribution side. So those of you who are out there building a practice and selling, you've seen your margins go way down because of more regulation and because of the fact that there's more competition. So let's move to the history. We all started out, I believe, and I could ask you to raise your hands in the room, but we won't have enough time, probably working for a proprietary company. I started with London Life, which was a great firm, or is a great firm. And I only sold their products, did that for 4 years, and then moved on. And then moved into the brokerage side of the business. And I think that's fairly typical of a number of people that you want to offer more to your clients. So once that happened, when the initial phase of when you were selling for a proprietary company, that was very common about 30, 20 years ago. All of a sudden, we saw the separation from manufacturing and distribution. Manufacturing was more than happy to dump distribution because it was the pig. It's the one that cost them all the money. And they could now, their margins were much higher. They didn't have the risk. They didn't have the liability. So we saw brokers move on, take higher compensation, both on the life insurance side and on the mutual fund side of the business. And I'm going to talk about the mutual fund side for a second. Distribution had to become a dealer. So if you wanted the highest payouts, you became a dealer, and then you went off and recruited a number of other advisors at fairly high payouts to supplement your production. And that worked real fine. There was no problem out there. The difference was manufacturing now had to gain the loyalty of the distribution network because it wasn't their own field force anymore. They had to gain the loyalty by buying, using trips, co-op advertising, marketing allowance, etc. Now, the world was just fine. We didn't see a lot of problems out there. There were always a few. Then all of a sudden, the regulators said, you know what? This industry is growing too fast. We need to do an investigation. Gloria Ann Stromberg came in. She did her job. She put out a report. One of the parts of that was we need to have a self-regulatory organization. But what ended up coming out of that was certainly higher capital requirements for dealers, dealers on the mutual fund dealer side, and IIROC already had that. In addition to that, you had to get, you were in a position where you had to increase your compliance and your self-regulatory responsibilities in terms of supervision increased, and all of a sudden the dealers saw that they didn't have the margin to operate anymore. Now, what did this do to manufacturing? Well, all of a sudden now manufacturing, who depended on distribution to sell their product, got scared. They said, these guys aren't going to survive. So along came the bigger companies, started with Asante, later on Dundee, and a number of the others, bought up distribution. And they did that to protect themselves. Okay? So but they didn't merge it back into a proprietary regime like say an investors group type of model. What they did is they kept them separate. And we still have that obviously today. But here, the whole difference was really manufacturing was still supporting distribution, or starting to support distribution again, but without actually having it as part of the same company. So you could sell multi-company products, as you know, but you kind of got, pushed and support that parent who the ones that are supplying the money. And this becomes a bit of a regulatory issue as well. So technically, it was to save the industry because the banks, as we all know, were almighty and all powerful. They didn't need to worry about that. They had their own distribution force. But if you were Trimark, if you were McKinsey, of course, I'm mentioning Trimark that does not have a distribution cycle. I'm not saying this negatively or positively. If you were Dynamic, CI, there was a threat there. And the threat was, these independents don't survive, who's going to sell our product? So that took place. Now, in terms of the regulatory reform, I can tell you as someone who's run 3 dealers, our costs skyrocketed. The risk-adjusted capital formula came into place, which is different from working capital. Risk-adjusted capital, every single time you got a contingent liability, you got to pop capital up there. And you have to estimate what the liability might be for lawsuits, et cetera. Reporting became no longer a nice thing to do for your clients. It became a requirement, and the dealer had to send out the reports, not the advisor, because it was more compliant and it was safer. That cost more money for the dealer. So what you're seeing happen, and this hasn't changed, it's just getting, I hate to use the word worse, but regulation is not going away, it's getting tougher. So our costs are going up when you're trying to run a dealer. Then you get a 30% market meltdown, and I can tell you right now, as I told my colleagues at a previous speech, there wasn't a dealer out there that was making money. And if they tell you they were making money, they're probably doing it to save face. So most of us needed a parent to keep us alive, okay, whether it was a publicly traded company or a big manufacturer. Now, the problem with that is the advisor doesn't totally understand that. They're down 30% in their revenue, and the dealer's cutting costs left, right, and center. The service is starting to go downhill, and companies are making tough decisions on executives and staff and all the rest of it.